All right, did we just have our Black Monday of 2020, comparable to our Black Monday of 1987? So we're going to break that down and take a look at today's move in context of these other big moves to the downside in past years, continue to show the comparisons to see how today's move aligns with what we've already been looking at and what our expectations are and what we can expect now the rest of this week with such a big move down to the downside to start the week. And for that matter, the subsequent rally we've had so far overnight to the upside. So we're going to break all that down, talk about whether, like I said, this is our Black Monday, and are we full systems go from here? And even if we are, how and when are we going to retest these lows? And what kind of move tomorrow would give us an idea that we are going to look like 1987, or if we're going to look more like the end of 2008. So I'm going to break all that down today and by looking at the charts, as well as a trade idea to see if we can take advantage of the extreme moves to the downside for some stocks for a stock, that's hitting a really big, significant long-term support level. So let's go ahead and get started. Today is Monday, March the 16th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we look at some charts, really quickly, I invite you to subscribe to our YouTube channel. Mouse over our logo right here. Hit the red subscribe button that pops out. There's also one down below our video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video. You got something out of it. Number two, you want us to do it again tomorrow. If you don't want us to do these videos anymore, then you don't have to click on anything. If you do, then let us know with one click. Really quick and really easy. It's our only survey that we have to get your feedback. Also, while you're down there, comment. What did you get out of our video today? Join our website at MarketScholars.com. There's a link right there popping out in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see here another day closing at the low of the day, coming well off of the last week's close. So big gap to the downside and a open that we didn't fill the gap, and then we close at the low. So again, this is not a bad, to gap down, gaps down get filled in, right? These will eventually get filled in. We've seen that even in the worst case scenarios. In 2008, we saw gaps to the downside like this get filled in eventually with big moves to the upside. Now, it doesn't mean that we won't retest this. And you can see there's a Fibonacci retracement line here. That goes back all the way to the March 2009 low point. So this big rally we had from March 09 up to here, this is the third, almost to here. Let's activate that and move that up to the actual high point here. You can see we are sitting basically right on the 38% Fibonacci retracement level of that big market rally. So put that in context, that's a tremendous move. Now we're also, if I go out a little bit further, you'll see we're also retesting the Christmas Eve low point, which is sitting right on that level now, right? Obviously it wasn't then, but it is now. Back then it was sitting more on the 23% level. So very, very important support here at 2350-ish for the S&P 500. But again, there's going to be an area of support here. If I were to go all the way back so you can see where that sits here and go to a weekly chart, you can be able to see where this level is. You can see the 50% level, which is not a Fibonacci retracement. It's just kind of the midpoint of this rally. That's where significant support is going to be right in this area. You can see why. That's where 2015 and coming out of 2016, that's where that low point is. So that's where after that there's not very much support down until we get down to really lower levels here. If I were to take a look at the Bollinger Bands, you see what I'm talking about. If I were to go especially if I were just to take a look at from March 9th low of 2009 up until now to see, and here let's get rid of that expiring cone for a second. You can see where that level is. See that big volume node, all right? That's about right where the 50% retracement mark is. And then you can see down here at the bottom, that's where the next layer of volume support with the biggest one down here. Now this is going to be gone here in a little bit, and that will make this the point of control. But regardless, you can see that's where the next significant layer of volume support is after we hit this 200 level, where again that's where the 50% mark is. And again, not a Fibonacci number, but it's a 50. It's a midpoint, and that's a midpoint can be a support in and of itself. One other thing too that kind of stood out to me today, and I tweeted this out. Today was the second biggest move that the biggest move that we've had in the market since 1987. 1987, you recall, was a 20% down day. This was a 12% down day. So big time move to the downside. You can see all the success, all the other bigger moves like this one was followed by a big move to the upside. Here's another big move to the downside. It was almost 10%. It was followed by a big move to the upside. So we'll see tomorrow if this is followed by a big move to the upside. You can see also that this is the biggest VIX level that we've had since 2008. The last time, 2008, you can see also the realized volatility got up to this level too. Right there in November 2008, we rallied into the year-end close. I did want to point out that 1987 mark, here's the, if you're looking for biggest days down, because you notice we didn't get very many big down days like this, not even close to this. But you can also see the biggest down days were followed by big moves to the upside almost every single time. 1987, here's where we're at. There's the move. So not the biggest move, but the second biggest move that we've had in modern times at least. And you can take a look too. If I were to go to rate of change, let's see how many periods would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 15, 16, 17, 18 days. So if I were to go to the rate of change on an 18-day period, you can kind of see it puts into context just the significance of this drawdown that we've had in 18 days. So 29% drop in 18 days, right? Coming down from this level right here, right? So we've essentially, so again, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. 1, 2, 3, 4 of those 18 days are to the upside. Remember, these are trading days, so this is over 4 weeks essentially. And considering it's February to March, we're almost a month. This is almost a whole month. But if I were to zoom out so you can kind of get an idea of, and here let's go back to 1985 again. Let's go back to 1980. And then go out to days. And then I'm going to put in a horizontal line here of 2953. So let's edit this, turn on the left extension, 2953. So this is the how much we've fallen in this last 18 days, 29.5%. You can see in 2008 the worst that we dropped was 21.5%. And then you can see that November time frame we got down to about 18%. There's the worst in 2000 during that recession. The worst was down about 16%. And then you can see here's 1987. And so as bad as it is now, it was this bad on an 18-day basis. It was this bad at the end of the run, right? So again, because keep in mind, there's a lot of Black Monday gets a lot of publicity, right, as it should. Black Monday, and this might very well be Black Monday of 2020, considering it's the second biggest down day ever. And this would be the first one on a percentage basis, of course. But if you look here, I mean, we were already down 1, 2, 3, 4, 5, 6, 7, 8, 9 days going into it. We were down quite a bit, and including 1, 2, 3, 4, 5, 6, 7, 8, 9. These are my 18 days that I had going into that, and so we were down 20 some odd percent, 30%, and that includes a little bit of a rally at the beginning of that 18-day period. So and very few down up days, only one up day during this because we didn't have circuit breakers or anything like that. So again, you can kind of see that this is a pretty significant decline, but we saw this before in 1987 at the worst of the 1987 drop, and you can see nothing since the early 80s. But at the worst of the 1987 drop, this is where we got to. And then again, we retested it multiple times. So even if we get out of this and we replicate 1987 and we get a couple up days just like this, big moves to the upside, you can see a week later we were close to those lows again. A month later we were close to those lows again. But then we never got to those lows again, right? So after that retest of a week later, after that retest of a month later, then we rallied 30% a year after that. And literally 30% a year for the next 10 years. And that was after being up 24% a year going into this high right here. We were up 24% a year for 10 years going into that high. We were up after this drawdown of 30%. We were up 30% a year going forward from here. And if we had the VIX back then, I'm going to venture to guess the VIX would have been tremendously huge. The VIX started in 1990. So probably would have, the VIX probably would have put, the value for the VIX would put this to shame. The other thing I wanted to show you too was how far down below the 30-day moving average we are. So if I go to the long-term chart here and then change the time for us, change the chart here to a 1 and 30-day. Hit OK on this and then change this to a daily chart instead of a weekly chart. So we are below the 30-day moving average now. We are about 30 or 20% below the 30-day moving average. So again, to put some context into where that is, be 20.09. So we are literally 20%. So 20.09. And hit OK, and let's left extend that. So, and let's go back to at least, let's go back to 1980 again. Okay, so going back to 2008, we got almost 20% below. We retested the lows, bounced right up to the 50-day moving average as it was dropping sharply, and then retested, right? So now let's go back to that 1987, and you can see we were at the worst, we were a lot further below the 30-day moving average. If I move over here. So, and again, in that one day, we bounced right back. We were 27% below after that big down day. And the day before, we were only 10% below. So we really pulled back there. But we've pulled back to the same extent here. And that's a significant amount below the 30-day moving average. In fact, for that matter, if you look at how far away we are below the 8-day moving average, and keep in mind the 8-day exponential probably has a little bit different value here. The PP only works with simple moving averages. But if you see how far, we're 10% below the 8-day moving average. Very, very short term. To kind of get an idea, we were only half of that in January of 18. And we were half of that at the worst in December of 18. This is the 8-day moving average, mind you. This is August 2011, again, only about 5% below. These were other really significantly bad times. Excuse me, that was 15. This is August the 11th. We were 8% below. That's pretty close. You look at the worst in 2010, and we were really close to 10% below, or we were at 10% below there. And then you can see going back to, well, here is 1987 right there. So 1987, we were 20% below the 8-day moving average. But the day before, and so that was in one day because we fell 20%. The day before, we were 7% below. So we were already pretty below, and by the time we retested right there, we were only 9% below. So absent a 20% down day, and this could very well be our 20%, because when you look again at the volume here, we had a pretty decent amount of volume again on the S&P 500, and you can see it started off. We had a really huge amount of volume on the weekly chart back there, and that was a pretty bullish opportunity on the S&P back in 2015 when things kind of hit the worst case scenario. So we're already starting off with a decent amount of volume now. So considering how far below we are, today very well could be the Black Monday of 2020. And again, if I take a look at like where we are in terms of linear regression, and you have to go back now a long time frame. The longer the time frame, the more significant the pattern. So here we are on a 20-year chart, and let's look at it on a monthly basis to make it a little easier to see. On a 20-year chart, look how we've hit the linear regression trend line. And we've been above that linear regression trend line for a long time, really coming out of that 15, 16. But if you have to kind of look at, by the time we were in this area, so if I were to go back to 20 years from, let's say, February of 16, to show you just kind of idea where we were, what it looked like back then, and then go 20 years ahead of that, so it'd be 03, 01, back to 1996, the monthly chart. So you can see the pullback there got us close to me. So it was back in this area that we finally came up above the 20-day moving average. If you looked at February of 09, to kind of get an idea of how bearish we were then, so 28 of 09, and go back 20 years from there, so that would be to 89. So you see how bearish we were at the end of that recession. We were 2 standard deviations away from the linear regression. Much different environment then as we were now, right? We're as bearish now as we were here in October, and we were, really, at the end of October, if you take a look at where we were at the end of this month, because that was the worst month of the Great Recession there, to 88. You can see that's where we finally hit the 2 standard deviations level, and we kind of continued for a while and hit that divergent low point. Well, looking now, we are not that far away. If I were to go to same thing, let's go to October 31st of 1987 compared to November 1st of 1967. So 20 years going into the Black Monday. So that's what it looked like there. So again, we were almost to the linear regression. So this is again looking a lot more like 1987 than it is 2007, 2008, that time frame. Going back to the 20 years. That's where we're just happen to be a little bit lower now. But we're also not done with the month either. Like we're not to March 31st yet. And you can see how these bearish months tend to end with long lower shadows that eventually get traded in, right? So we'll most likely end this month, if it does what it has done in the past, we'll end this month with a long lower shadow, which means the end of this month will be more bullish than bearish, as we'll ramp up to some level, wherever that level ends up being, but through the ups and the downs. But then in April and May, we'll probably trade within that area again, that long lower shadow again, if we follow the typical pattern of these types of moves. So keep that in mind. But if I were to go to a 10-year linear regression, we are 2 standard deviations away. We still are, right? We were before. We still are 2 standard deviations away. And same thing on the 5-year basis, and especially even on the 1-year chart, we are 2 standard deviations away. So, which gives us that margin of safety to the downside. We are 30% down now from high to low. We are 30% down now. Are we going to fall? As someone mentioned to me on Twitter, are we going to fall another 20% from here? Well, according to these charts, it's very unlikely we are. Which, when you see people saying, you need to get out of these cyclical moves and get into safer trades, well, that's the story up here. When we're really, really bullish and the VIX is really low, we talked about de-risking for a couple of months at the beginning of the year. That's when you de-risk, right? You don't de-risk now when you're already down 30%. Now is actually when you start, because again, the expected return, the returns from that low point in 1987, 10 years out, was 30% a year. The last time we hit the VIX at this point, 10 years out from there, we were up over 20% a year, 25% a year, on average, from that 2008 low point, November 20th, 2008. So, I mean, the returns you get on some of these stocks were really, really good from those levels. Obviously not nearly as good for some others. You can see here's the 10-year return. And again, remember too that the market was pulling back in November of 18. So we had peaked in October of 18. We were pulling back pretty sharply. But here's the sector returns from that November. And you can see there's that low point. There's that new low point to March. And that's what everybody's worried about right now. Oh, where's the new low point going to be? Well, this will kind of give you an idea. I mean, look at that context right there over here on the left, bottom left. That's the new low point in March of 09 after the VIX hit 80 in November of 08, excuse me. That's the new low point. So, and that's the returns afterwards. You can see technology, for the most part, technology, discretionary, financial started up. You can see industrials kind of had a good run here at the beginning too. They both outperformed. Healthcare had a good run here kind of in the middle. You had a nice decent run on healthcare, and you can see there's your staples, utilities, utilities and staples kind of lagging behind. Keep in mind financials also. There's an element of real estate in there that actually dragged that down a little bit. The actual financial sector did a little bit better. The banking part of the sector, the real estate sector kind of dragged that down just a little bit there. So you can see, and of course energy lagged the whole time, and so did materials, as the dollar is mostly bullish during this time frame. But, you know, again, was that the best time to get to go into safety when the VIX got to 80? When, you know, that's your, I mean, they lagged, these staples and utilities, you notice they lagged the whole time, and healthcare did too for a while. Now this might be a little different for healthcare because they might be part of the solution rather than just simply a safety trade. But the safety sectors, you know, a year to 2 years out were lagging behind. Your cyclical sectors were the outperformers, and then they continue to lag the whole entire time. So, you know, if you're looking for some good investments 10 years out from now, you know, when we're in 2030, as hard as it is to think about that right now, but even 2021, we're March of 2021, because here's November of 09 right here. When you're in March of 2021, are you going to be wishing that you had gotten into your staple companies right now versus, say, earlier when we were talking about de-risking, right? When you get to a level that you haven't gotten into those lows, at an earlier period of time at some of these cyclical areas, when you hadn't gotten into those, and you're starting to lower your deltas in your portfolios as the market gets more and more bullish. Well, one way on an equity standpoint to lower your deltas is to lower those beta-weighted stocks from the higher beta companies to your lower beta companies that obviously hold up better on the pullback. Let's take a look. I showed you how far below the 30-day moving average we are, and this shows you how far the 8-day moving average is on the absolute value below the 17-day. So very, very bearish. You can see the histogram is down to a really low level as well. If you take a look at the 4-week range, the high to the low, that's a 30% high to low. So just to kind of show how much the rubber band is stretched out, 10% is a pretty good stretch. 15% now, and now we're at 30. So just keep in mind, the more we stretch, once you let go, the rubber band pops back even more. So like the more we stretch, the bigger the up moves are going to be. Now that doesn't mean that the up moves will like V-bottom recovery, right? It just means that there's going to be a couple big up moves, probably up towards this 285 to 300 level. That's going to happen really, really, really quickly, out of the blue. Like nobody's going to be expecting it, and everybody's going to be like probably chasing it. And what we're going to use it for is an opportunity to get out of some bullish trades and into some more, so get into some bearish trades as we've seen even in night 87, we eventually retest these lows, whether it's a week later or a month later. Very high probability after filling in some of these gaps that we retest those lows. Now, if we get a move up to the upside, if we get a strong gap to the upside that we never fill in, even on a little bit, tomorrow, for example, then that could be very well what's called a runaway gap, where we start the bullish move, the bullish intermediate run, and it doesn't get filled in for a long time. I'm going to venture to get, and right now, if you notice, SPY is up overnight. So we're at 251 versus 230, 240, which is where we're at before. So we are up quite a bit. So now the question is, do we fill that in? As you've seen previously, when we gap up, we tend to fill it in pretty quickly. Like right there, we gapped up, we filled it in pretty quickly. Over here, I think there was another move up. Well, this was a gap up. That was our only one. I thought there was another one, but that was our only gap up that we filled in over here. We gapped up, we filled in very quickly. And all the rest of these were gaps downs. So if we gap up, which as of right now, and of course we got a long night, but as of right now, if we gap up and don't fill it in very quickly, which is the normal pattern, then again, runaway gap. And that could mean that we might not retest those lows. We might retest that gap, but we might not fill that in. And that would be our runaway gap. So we'll see. We'll see how it plays out tomorrow morning. More likely than not, I don't like the fact that we're gapping up like this. More likely than not, we'll gap up with a strong move to the upside overnight. Like, we're up how much now? 251 out of 239. So 11 points. So almost 5%, 3-4%. So we're moving. That's a nice move. But the bigger it is, the more likely we are to come back down overnight. But if we don't, then we know the bigger it is, and we don't fill it in immediately, then we know runaway gap. Good chance we move up to 300 into this area, and then at that point, de-risk big time from a bullish delta standpoint and load up more on some bearish deltas, because you'll have some opportunity. You'll have some pretty strong resistance on an intraday basis here at that point. And the opportunity to fill in some of this area with some more volume, some of these volume gaps here. So that's kind of how I'm watching. You can see, obviously, from a Bollinger Band standpoint, we're well below the value area. So again, another reason why 300 is going to be a very strong support level, because then now you have that on. That's been below us for so long. Now it's above us, so it's going to act as a big old resistance. It's going to be hard to punch through, unless you're like that X-Man character Juggernaut, where you can bust through that thing. More likely, we're not going to. On a 5-year chart, here, let me get rid of that, this expiring cone. On a 5-year chart, you can see, again, how significant the volume is going to be in this area. So, big volume node, and then, of course, that's where your 300 area is. But you can see a lot of volume. So, there's a good chance that there's an opportunity that we can fill in this gap of volume with some ups and downs here. As we trade. We're well below the lower band. We made a big close below the lower band, and the band width is as high. I mean, if I were to go all the way back, and this is on a weekly chart, but even just go back to 1980, to kind of get an idea, because the bandwidth is an apples to apples comparison too. We actually had a bigger bandwidth in 19. Now this is just starting, so the bandwidth is pretty high. It's going to. We're not, even if we bounce tomorrow, we're still going to get a bigger bandwidth. So we still have an opportunity for that to move up. You can see in 2007, we had a really big bandwidth that ended that bear market. That was the one that ended this bear market. And then if I were to go, we can't go back to, let's go to SPX and then come out here. There's your 1987. Again, very similar bandwidth, as high as we got to. Big move to the downside. Big gap below, like you saw right here, and that set the low point. Same thing as we saw in 2008. That set the low point right there, and then the successive low point later. And then in 2002, as I mentioned before, that actually set a low point, and that set a low point. So when you get these big gaps down below the, you can see all along here, when you get these big gaps below, that sets the lows, and here we are again getting a big gap below, and that's setting the low point, or potentially setting the low point on the S&P 500. So one last chart here, and again we are down 29%. So if we do make a run, we are going to make a run back to the 200-day moving average. But the fact that we're down more than 20% suggests, similar to what we saw over here when we fell below the 20% mark, similar to what we saw over here, that there's a good chance that we fail at the 200-day moving average when we bounce back up. Now, in 1987, that wasn't the case. We fell down just like this, very, kind of a one-off type of move that had a huge impact on the economy back then, in the late 80s, to the point where by the time we were in we were in a recession over here, and that cost the incumbent president the election at that point. It was a few years, so you can't really compare it to the current presidential outcomes. But the idea was that led to eventually a recession over here. But if you notice, it wasn't a recession that went to new lows. We set the low there, and then we rallied. And then, because it took so long to get to new highs, and because it was such a big low point, we still rallied to new highs even during that recessionary move in Kuwait and and everything else. We went up 10 years later, like I said, 30% a year. So are we like early 2008, mid 2008 actually, or are we 1987? And again, it seems like more and more likely, because of how significant, how extreme the move is, that we are looking more and more like 1987. I mean, we think how bad this was, but the reality is, if you recall, the only reason why we're up this high is because of the FANG stocks. The broad market itself was not up that high. The Russell 2000, if you notice, was not up above its October 18 high points of where one of the bear market tops filled in. If you look at the equal weighted S&P 500, we did rally, we were up, but not nearly to the same extent as what we saw on the S&P, which is not obviously equally weighted. So those FANG stocks had a big impact on us moving up as high as we did, and but even with that, we've seen a move like this. So we might say, well, 1987 we weren't coming from the highs. Well, we weren't, and it was still a big number, but that was a pretty artificially inflated high by those trillion-dollar mega cap companies that really led this market up to this artificially higher high that we didn't see in all the rest of the broader market outside of those 500 issues. With that said, now I want to talk about our trade idea, and one of the sectors that really got hit pretty hard today was Lowe's. I tweeted this out. The stocks that had one of the it's not Lowe's, home builder, sorry, or anything related to home building. This sector got hit hard and way below its 30-day moving average. You can see we went from an overbought cluster to an oversold cluster, just like that. Of course, a lot of things are really close. The S&P did that too, so it's not like it's out of the realm of possibility here. If you look at the weekly chart, we are just barely turning red. But if you also notice, we got a lot in the last 5 years. We have a lot of trading in this area. So again, you look at lows and you say how far down below the moving average we are, can set a low point, especially as extreme as we are in this case. A lot of these other examples kind of set some low points. This is more extreme than that. But I also noticed this. On a 5-year basis, we are at some significant support. So either we really fall from here, or we really bounce up back towards 100 very easily and very quickly as the market itself, and fill in some of these gaps that the stock has. If you notice, it's got a gap here today. Here's some of the other gaps. Going up to 100, 105 would fill some of these in. And again, the market gets really big, strong moves really quickly out of nowhere, and then we'll backfill and take a bit longer to bounce back up the next time because the volatility index won't be so high. But we have an opportunity to take advantage of Lowe's being as low as it is. And so what we've done is we went out of the money and we bought a call option here on Lowe's, and position size around the worst case scenario. So here's the trade. We bought the $90 call option. We went out of the money so that we could position size around the worst case scenario. You notice here, let's see where we at. We're down $250 on this trade, so you can kind of get an idea of this is where we got in, this is where we're down. This is just a matter of like overnight trading. But if you notice in the last 50 minutes of trading, you notice in the overnight we're right back up to that $80 level. The bids move back down, but the ask has moved back up. So we move right back up to that $80 level right here to try to overcome that, which will move us back into this area, back towards our break-even level and beyond. And if we do get up to 100, you can see for the $500 at risk that we have, and you can see as much as we move down towards that tremendous support here. My margin of safety, there's not a whole lot more left to lose. I'm only down $250, but I have the opportunity to make $1,500, $1,700 or more as the stock rallies up to the upside. The other issue too was letting that volatility. If volatility drops, we went out of the money, so it doesn't drop very much. If you notice, the volatility levels here are really high. Over here. They're really high, but as you notice, volatility will drop especially as you have really, really high volatility here compared to the back month. So that volatility is going to drop pretty sharply. Won't drop as much out here because we're only at 59, and as the stock bounces up and this becomes in the money, then you see how much bigger the volatility will be. So we'll be able to offset some of that with a move to the upside. So we'll be able to keep that steady without volatility, negative vega. You can see this, I have a 12 vega here. That won't be nearly as impacted by volatility changes because as the broader complex falls, the individual issue itself will gain as we go further in the money. And the more we stay down, the more volatility will stay up. And that will help offset any negative deltas, which have gotten smaller as the stock has pulled back, like I said, just in the last 15 minutes since we got into this trade. So an opportunity here to see if we get a nice good bounce to the upside. And the bigger the bounce, the quicker it is, the more we can be able to get out even quicker too. Like I said, for $250 of risk, or 500 even, but you know, if we're essentially putting $250 at risk, 250, $300, then then, you know, again, 750 is 3 to 1. $1,000 would be a 4 to 1. So if I were to get $1,000 to $1,500 very quickly in return, we can take it, considering the risk we have, depending upon how quick the bounces are. So that's kind of this has got the potential to be a really, really quick trade if the market gives us good, quick, big bounces out of nowhere. And if they last by the close, if they're not just all overnight in the open, we'll take those gains and move on to something else. Like I said, something more bearish as we come back and backfill back to these lows a little bit slower than we did this first time. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Let's keep this conversation going in our community. Use that link right there popping out in the top right corner. It takes you to our Market Scholars website, to our community portion, the free portion of our community, our Market Outlook Forum. Open up an in-you thread, ask any questions or post any comments you have about what we talked about, and then reply and respond to other people as well. That's, like I said, keep this conversation going within this community of viewers and traders at Market Scholars. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter in between the videos for more content. And like I said before, join our community at Market Scholars, as well as our Facebook group, as I showed you. So thank you very much for coming on. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.